Did you know that over 1.4 billion people worldwide still don't have access to a traditional bank account? That's nearly 1 in 5 people on this planet. Governments and central banks claim that CBDCs, central bank digital currencies, will solve this problem and bring millions into the financial system. But is that really true? Or is it just another buzzword solution? Today, we'll uncover the myths versus reality of CBDCs and financial inclusion, backed by real-world data, case studies, and trials happening right now across the globe. Welcome back to the channel. If you're new here, we break down complex financial topics into clear, actionable insights. And today, we're tackling one of the hottest debates in finance: whether CBDCs can actually deliver on the promise of financial inclusion. We'll dive into what central banks are promising, what the data really says, examples from countries already testing CBDCs like China, Nigeria, and the Bahamas, and why some experts believe CBDCs may create more barriers instead of removing them. Stay till the end because I'll also share 3 key takeaways for what CBDCs really mean for everyday people, especially the unbanked and underbanked. Infographics of unbanked population statistics by region. Let's start with context. Financial inclusion means giving everyone equal access to affordable and reliable financial services, whether it's savings accounts, payments, or credit. According to the World Bank, as of 2021, 24% of adults worldwide still had no access to a bank account. In sub-Saharan Africa, the number is higher. Nearly 57% remain unbanked. Even in advanced economies, millions live paycheck to paycheck, without access to affordable credit. This is the gap CBDCs are supposed to fill. But financial inclusion isn't a new challenge. Mobile money platforms like M-Pesa in Kenya have already brought millions into the system, long before CBDCs. So the big question is, are CBDCs a game changer, or just a central bank response to innovations that are already solving the problem? Myth number 1. CBDCs automatically bring the unbanked into the system split screen. Myth versus reality. Central banks often claim that CBDCs will bank the unbanked. But here's the reality. Access to digital currency doesn't mean access to the financial system. Think about it. If someone doesn't have a smartphone, reliable internet, or even basic ID documents, can they really use a CBDC wallet? Take Nigeria's eNaira. Launched in 2021. The government pitched it as a tool for inclusion. But by 2023, adoption rates were under 1% of the population. Why? Lack of awareness, low smartphone penetration, and distrust in government-backed systems. So the myth that CBDCs magically solve inclusion isn't supported by the data. Myth number 2. CBDCs will replace costly remittances. Another big promise is that CBDCs will make remittances cheaper for migrant workers sending money back home. Yes, it's true that traditional remittance services like Western Union can charge up to 10% in fees. But CBDCs aren't automatically cheaper. For example, the Sand Dollar in the Bahamas made payments faster, but fees didn't significantly drop, because infrastructure and intermediary costs still existed. In contrast, Fintech apps like Wise or Revolut are already reducing remittance costs without needing CBDCs. So unless CBDCs integrate into global networks seamlessly, the idea that they'll revolutionize remittances remains more myth than reality. Reality: CBDCs could create new forms of exclusion. Now here's the uncomfortable reality. Instead of solving inclusion, CBDCs might actually create new forms of exclusion. How? Let's break it down. Digital divide. In rural areas with weak internet, cash is still king. A CBDC-only system risks leaving those communities behind. Surveillance concerns. If people believe CBDCs let governments monitor every transaction, many may choose to avoid it altogether. Technical barriers. Elderly populations or low literacy groups may struggle to adopt complex apps. In short, CBDCs could unintentionally widen the gap between the digitally literate and the digitally excluded. Elderly person confused with smartphone versus young person scanning QR code easily. So, what's next? By 2030, over 100 central banks are expected to have experimented with or launched CBDCs. Some will succeed in improving access. Others may fail spectacularly. Risks to watch out for. Over-centralization. If CBDCs replace cash completely, people without access to digital infrastructure will be excluded. Privacy trade-offs. To fight crime, governments may enforce strict ID checks, again locking out undocumented populations. Competition with fintechs. Instead of collaborating, CBDCs may crowd out private sector innovations that are already driving inclusion. But there are opportunities too. If CBDCs are designed as offline capable, interoperable, and low-cost, they could genuinely bring millions into the system. The key is whether central banks listen to real-world user needs, not just theory. Recap highlights with bold keywords. Myths versus reality. So let's wrap this up. The myth is that CBDCs are a silver bullet for financial inclusion. The reality, backed by data, is far more complex. CBDCs can help in certain contexts, but without solving issues like smartphone access, digital literacy, trust, and affordability, they risk becoming just another government experiment. Here's the key takeaway. Financial inclusion is not just about technology, it's about people. CBDCs could be part of the solution, but they are not the solution. If you found this breakdown valuable, don't forget to like, subscribe, and share this video so more people can join the conversation about the future of money. And I'd love to hear from you. Do you think CBDCs will really help the unbanked? Or is it overhyped? Drop your thoughts in the comments below. Subscribe button plus next video recommendation on CBDCs.